Hey everyone, welcome back to the deep dive. I gotta say, I've been watching the Nasdaq pretty closely lately.
Yeah, hard not to, right?
I mean, it's just been on a tear for so
He
long,
really has.
and we've seen some pretty incredible growth from companies in that index. You think about names like um, Nvidia or Palantir Technologies, just to name a couple.
Yeah, those are definitely some high flyers, no doubt about it.
Exactly. And so when the market sort of takes a little breather, like it's been doing recently,
Mm-hmm.
it kind of makes you want to take a step back and think,
For sure.
is this like a sign to get out?
Yeah.
Or could it be, maybe it's actually a good time to jump in?
That's always the big question, isn't it?
Yeah. And that's exactly what we're going to be diving into today. We're going to be looking at this recent market movement through the lens of, well, you could say a legend in the investing world, Warren Buffett.
The Oracle of Omaha. Always a good source of wisdom.
Right. And we've got a really, really insightful article here from the Motley Fool. It basically takes a look at how Buffett's, sort of time-tested wisdom and his approach might give us some valuable perspective right now.
I think that's a great idea. I mean, anytime you can glean insights from someone with his track record, it's worth paying attention.
Absolutely.
Yeah.
So, Buffett, he's the guy behind Berkshire Hathaway, right?
Yeah,
And
of course, one of the most successful investment companies of all time.
right. And I mean, his company, it's delivered an average annual return of almost 20% since 1965. That's
Wow. Yeah, that's phenomenal.
just to kind of put that in perspective. The S&P 500 over the same period, it's only averaged about 10%.
Right.
So, that kind of consistent outperformance, that's not just luck. That really speaks to a disciplined and a really effective investment approach.
It definitely suggests there's something to be learned from his strategy.
Yeah, totally. And the article kind of digs into this. Buffett's strategy, it's not about, chasing the hottest trends or trying to predict every little market swing.
No, he's very much a long-term, value-focused investor.
Right. He's famous for really zeroing in on like these high-quality companies that have real staying power, real long-term potential. Think about some of his classic investments, the ones he's held for years and years, like Coca-Cola or American Express.
Those are definitely some of his hallmark holdings.
Yeah. And his whole approach is, to buy these great businesses at a sensible price, or ideally, like even a bit of a discount.
He's a big believer in getting a good deal, that's for sure.
Yeah, totally. And then he's in it for the long haul. He's not trying to make a quick buck or anything like that.
He's playing the long game, very patient capital. It's really a core principle of his philosophy.
Yeah. And that actually leads to a really interesting point that the article brings up. Over the past year, Berkshire Hathaway, they actually became a net seller of stocks to the tune of, get this, $134 billion.
Wow, that's a pretty significant move.
It's a lot of money. And so now they're sitting on like a record level of cash, something around $334 billion. I mean, that's a lot of capital just waiting on the sidelines.
It's a signal for sure, but the question is, what's the message behind it?
Exactly. And here's what's really fascinating. He decided to sell off his entire position in both the SPDR S&P 500 ETF Trust
Interesting.
and the Vanguard S&P 500 ETF.
That's a pretty big departure from his usual stance because historically he's actually been a big advocate for, investing in broad market index funds. I mean, he's even recommended them like in his estate plan for his wife.
Right. That's what makes this so interesting. So for him to actually reduce his exposure to those broad market trackers, especially when the market was at those higher levels last year, I mean, it kind of makes you think, maybe he wasn't too keen on the overall valuations at the time.
Yeah, you could definitely interpret it that way. He was clearly seeing some potential risks.
But, the article does mention that we don't actually know what moves he might have made in the past few weeks, during this Nasdaq correction.
That's true. We don't have real-time visibility into his portfolio decisions.
So we've got to keep that in mind. I mean, his actions last year give us some insight into his kind of general market sentiment, especially when valuations were looking a little stretched. But we can only speculate, really, about what he's been up to recently.
Yeah, fair enough. But you know what? This whole conversation, it actually reminds me of a really, really crucial piece of wisdom that Buffett shared once.
Oh, yeah.
And it feels particularly relevant right now for investors like you who are trying to figure out how to navigate this whole Nasdaq situation.
Okay, I'm intrigued. Spill the beans. What's the wisdom?
All right, so picture this. It's one of his past shareholder letters, right?
Yeah.
And in this letter, he drops this almost like a 6-word clue. He says, "Be greedy only when others are fearful."
Be greedy only when others are fearful.
Yeah.
I can see how that's relevant.
It's such a simple statement, right? But it's incredibly powerful when you really think about it, especially in the context of market downturns.
Okay, yeah. Break that down for me.
So let's think about this recent dip in the Nasdaq. Prices have fallen, over 10%? And a lot of that is driven by worries about tariffs, inflation, things like that.
All that stuff in the news that makes people a little nervous.
Exactly. And those are the kinds of situations where, let's be honest, a lot of investors, they start to feel a bit of fear, a little uncertainty, and they might even start selling off their holdings.
Yeah, people get spooked.
Exactly. But Buffett, he's saying, hey, those periods, those times when the market is kind of freaking out, that's actually when you want to be looking for opportunities. Because when there's that kind of widespread hesitancy, that fear, it can actually create some really attractive entry points for those who are willing to kind of, go against the grain a bit.
Yeah, so instead of running for the hills with everyone else.
Exactly. You could potentially be picking up shares of some really solid companies at a discount because all that fear, it can push prices down further than they should be based on the company's actual fundamentals.
So it's kind of like that old saying, buy low, sell high, but with a deeper understanding of how market psychology plays into it.
You got it. It's about having the confidence to think differently, to potentially act when everyone else is running for the exits. Because sometimes those moments of panic, they create the best buying opportunities.
Okay, that makes a lot of sense. But there's got to be a catch, right?
Well, the article does make a really important point, and it's this. Just because a stock has dropped in price during this Nasdaq correction, it doesn't automatically mean it's a screaming buy. It's not a signal to just throw money at everything that's down.
Right. You can't just blindly jump in and think you're going to make a killing.
Exactly. Because there could be some real legitimate reasons why a stock is down. Maybe the company is facing some serious challenges.
Like their business model isn't working anymore.
Right. Or maybe there's, some big concerns about their long-term future. So you really got to be careful. You got to be selective.
So how do we do that? How do we tell the difference between a stock that's down because the whole market is down and a stock that's down because something's actually wrong with the company?
Well, the article talks about a metric called the S&P 500 Shiller-Cheapy ratio. It's a bit of a mouthful, but basically it looks at the overall market valuation relative to inflation-adjusted earnings over the past 10 years. So it gives you a sense of whether the market is overvalued or undervalued compared to historical norms.
Okay, so like a long-term view of how expensive the market is.
Exactly. And what's interesting is this ratio, it has come down from some of its recent highs, but it's still above its historical average.
So even after this dip, things might still be a bit pricey overall.
That's one interpretation, yeah. So the point is we're not necessarily in a everything's on sale kind of situation. You really got to get into the weeds and look at individual companies.
No shortcuts, huh?
No shortcuts. Due diligence is key. And the article actually highlights a couple of really important questions you should be asking yourself if you're thinking about buying a particular stock right now.
Okay, lay 'em on me. What are the questions?
All right, so first, how much are those economic headwinds we talked about, those tariffs, that inflation, how much are those actually going to impact the business you're looking at? Every company is different, right? Some are going to be more sensitive to those factors than others.
Yeah, it makes sense.
And then, just as important, does the company have the financial strength to weather those potential storms?
Yeah, that's huge.
You got to look at their balance sheet. How much debt are they carrying compared to their equity? And how good are they at generating consistent free cash flow? Those are some big indicators of whether they can handle tough times.
Yeah, if a company is loaded with debt or their profit margins are razor thin, they're going to be a lot more vulnerable when the economy slows down.
Absolutely. And that brings us to the second key question. It's this. Are these current challenges actually going to change the company's long-term growth prospects?
Oh, interesting.
Yeah. You got to ask yourself, is this just a temporary blip, a bump in the road? Or has something fundamentally changed in their industry or with their competitors that could really hurt their ability to grow and succeed in the long run?
So it's about separating the companies that are down because of temporary market jitters from the companies that are down because their whole business is in trouble.
Exactly. And that's where the real opportunities lie, right? As the article says, sometimes these corrections, they actually reveal fantastic deals on companies that have proven their earning strength and have the ability to continue excelling over the long run.
So it's about finding those diamonds in the rough. The companies that have been unfairly punished by the market and that are actually poised to come out even stronger.
Absolutely. And if you can identify those companies, the ones with strong fundamentals and a bright future, and their stock prices taking a hit simply because of the broader market sell-off, well, that might be your chance to be a little greedy, just like Buffett would say.
Yeah, it's about having that long-term perspective
Yeah.
and not getting caught up in all the short-term noise and panic.
And it's also about having conviction in the companies you invest in, doing your research, understanding their business, and believing in their potential.
Okay, so just to sum up, the main takeaway here is that while a Nasdaq correction can definitely be a little unnerving, it doesn't necessarily mean it's time to hit the panic button.
No, not at all. Corrections are a natural part of market cycles.
Exactly. And in fact, if we look at it through the lens of, Warren Buffett's approach, his long-term focus, and his whole be greedy when others are fearful philosophy, it suggests that these corrections can actually be a great opportunity for those investors who are willing to do their homework.
It's a chance to potentially buy into great companies at a discount.
But, and this is really important, you got to be careful. It's not about just buying every stock that's down. You really got to do your due diligence, analyze each company individually, and make sure you're invested in businesses that you believe in for the long haul.
That's absolutely key. It's about being selective, not impulsive.
So for everyone listening, here's something to really chew on. Think about how those emotions, fear and greed, how they influence your own investment decisions. Yeah, we all feel those emotions, but how do they actually play out in your actions?
It's a good question to ask yourself.
And how might adopt in, Buffett's kind of long-term value-oriented perspective, how might that actually change your strategy, especially in a market that's always going to have its ups and downs?
Right, because markets are cyclical. There will always be periods of growth and contraction.
Exactly. So think about those companies that you really believe in for the long term. Are there any that, maybe their stock price has taken a bit of a hit recently? Could this be an opportunity to buy in at a more attractive price?
It's about turning potential fear into a strategic advantage.
That's a great way to put it. It's about developing that critical mindset, doing your research, thinking for yourself, and acting with intention, even when the market gets a little crazy, because ultimately, that's how you build long-term wealth. And that's what we're all about here on The Deep Dive. Thanks for listening, everyone.
And remember, always do your own research before making any investment decisions.
That's right. We'll see you next time.